Okay, I think we're live. Welcome, everyone. My name is Libby, and I'd like to thank you for joining us today for the webinar, Helping Small Business Clients Save in 2019 and Beyond, leveraging Section 199A's 20% deduction. This webinar is going to be presented by Robert Bloink and William Byrnes. Professor William Byrnes is the Associate Dean at the Texas A&M Law School. William and Robert are both professors of the online Wealth Management Master's Program. They are also co-authors of 3 annual tax books that have sold to the wealth management industry in excess of 150,000 copies. Robert's insurance practice incorporates sophisticated wealth transfer techniques, as well as counseling institutions in the context of their insurance portfolios and other mortality-based exposures. So before we begin, there are a few things that I want to go over. If you have any concerns or questions, there's a chat box in the bottom of your screen. There's an Ask a Question tool that you can use. We're going to do Q&A at the end of the webinar period. So any questions that you have throughout the webinar, submit your questions there, and I'll read them aloud, concluding the webinar. This is all going to be recorded, so if you have to jump off or you would like to share with a colleague, you'll receive an email in the coming days with the webinar link with the archived webinar. So at this time, I'm going to turn over the presentation to Professor William Byrnes of the Texas A&M University Law School. William, take it away.
Howdy. So as we begin every class here at Texas A&M on campus with our Texas warm welcome, I am William Byrnes. I am the, I'd like to say, the Oz behind the curtain for our wealth and our risk program. Today we're going to share with you information about the new section 199A. So in colloquial terms, the 20% business income deduction that the Tax Cuts and Jobs Act has bestowed upon us for the tax years of 2018, being last year that we're filing by April 15th, up through the tax year of 2025 that we'll file in April of 2026. So the first question I get with the 20% deduction is always, where do I actually find it on my 1040 or other schedule? So on the screen before you, you see the 2018 Form 1040 that your clients are submitting this year. On page 2, the back page, you see circled in red the 9th line, clearly identifying qualified business income deductions. So I have a nice big red arrow pointing to it. And anyway, so there we find it on our back page. So technically, it's a below the line deduction, albeit the description doesn't really fit anymore because page 1 of the 1040, I'm not going to show you that one, but if you're looking at page 1, all page 1 has on it today is collecting information on the taxpayer, name, social security, and address. Whereas before, of course, below the line meant everything below the first page. So our terminology is in the tax world is a little bit turned upside down for the at least back till 2026. Now, Robert and I will host a future webinar on understanding the 1040 and the new 7 schedules and all that. No worries, that'll be next time. Let's focus now just on the terminology about certain qualifying pass-through entities, which service businesses qualify, the threshold amounts, and so forth. So these are the issues we're going to be looking at. Now, all the financial advisors listening in today are aware that we have the same 7 brackets as previously before the Tax Cuts and Job Act. However, the rates have slightly changed, as you can see on the slide before you, and also the income amounts have slightly changed. There are some donut holes where individuals who are single and generally live in states with either high property tax, high income tax, or a combination of both, such as California, New York, New Jersey, who actually end up paying more tax as a result of the Tax Cuts and Job Act, not less tax, just based on having lost the personal exemption. That's been eliminated until 2026, based on falling into the 35% rate, where previously they may have been in the 33% rate, as you can see on the screen before you. So, by example, their income was $230,000. Under the former brackets, you'd see they're at the 33% rate. But under the new brackets, they're in the 35% rate. The point of that is that it's probably more important for those donut hole individuals in particular to want to make sure that they get advantage of the 20% business income deduction to moderate, to mitigate against this increase in their taxes as a result of the Tax Cuts and Jobs Act. Now, another question that we've received often in our classes in the wealth management and that we've been working through the analysis on is, well, the corporate tax rate has permanently been made 21%, and the individual rate is temporarily 37%, but it's going to go back up to 39.6% probably in 2026. So shouldn't I incorporate? Now, with the qualified income deduction of 20%, the effective rate on business income will be 29.6%. So instead of paying a full seventh bracket 37% income tax, by example, on $500,000 of business income, I subtract 20% if the AGI on the business income was 500,000. So I've reduced the 500 to $400,000. 20% times 500,000, 100,000 deduction on that line 9 of the second page of the 1040. My effective rate is just under 30%. You'll say, well, still 30% is higher than 21%. Well, that's correct, except that the money in the corporation still needs to be distributed to me as the shareholder. Now, that distribution is going to attract, if I'm in that 37% bracket, the highest rate of the capital gains tax. So recall that dividends receive the preferential capital gains rate. Thus, it's a 20% high capital gains rate. And you'll say, but I see the figure 23.8% on the slide. What gives? The ACA, the Affordable Care Act, which is commonly known as the Obamacare, carried with it an additional tax that is paid on investment type income. That additional tax is 3.8%. So consequentially, the 20% preferential rate plus the 3.8% gives us the 23.8% that the dividends will incur. So the cumulative tax burden on corporate income in the hands of the shareholder is just under 40%. That's on the left column of the slide. Where for the individual who's earning the business income, whether it's through a pass-through LLC, LLP, an S corporation, in their own name as a proprietor, with that 20% business income deduction pursuant to Section 199A, the effective rate is just under 30%. So as you can determine on the slide, there's approximately a 10% tax savings by holding the money in your own name. However, many clients are going to ask you, well, that's fine for now, but the Tax Cuts and Jobs Act is going to sunset, expire the 20% business income deduction. And without it, I'm going to be paying the old bracket, again, of 39.6%. So the difference between my pass-through business income in the year 2026, if Congress doesn't act, and receiving the money through corporate, the difference is negligible. So shouldn't I be thinking about incorporating in the future? The answer for that is yes, they should be thinking about incorporating in the future, because the money that is earned through the corporation at the 21% permanent rate isn't required to be distributed. It can sit tax deferred until distribution, and thus the earnings on it can earn outside of attracting the personal income tax rates, again, until distribution. So there would be a slight, over time, tax savings through the corporate route. Having said that, most people think that Congress will act to maintain at least, if not the same, but some advantage of pass-through entity business income as opposed to corporate income. Yet, it's a good reason for your clients to continue to consult you over the coming years as the scenario changes and as the Tax Cuts and Jobs Act gets closer to sunsetting both the slight reduction in the personal income tax rates and this 20% deduction. So now let's turn to the actual new Section 199A that takes effect for last year's taxable income. Now, for those who are earning business income, who are listening in on this webinar, many of you are financial advisors and underwriters, by example, selling life insurance. So Robert and I have great news for you. Like the best planning alternative, just to cut to the chase, and then we'll work through the slides to get there, is that, first of all, life insurance underwriters, the new regulations that were released to explain Section 199A specifically exempt you from that application of a special service business that applies to lawyers and accountants and management consultants and so forth. But it doesn't apply to life insurance underwriters. So, a very powerful lobby there. Secondly, as we work through the 199A on the next few slides, you're going to see that it is better, when possible, to plan for the AGI, the adjusted gross income element of having the 199 apply to your business income than it is to exceed that threshold and be forced to confront the formula based on W-2 wages or W-2 wages plus a percentage of basis in your investment assets of the business. So, sorry, your operating assets of the business. So we're going to be talking about the AGI, reducing our AGI. And to reduce AGI, the best way is retirement planning that involves our life insurance financial advisors. So the basic mechanics of the 199 is that if you can fall beneath the thresholds you read on the slide before you, married couple, $321,000, 400. Individuals, half the amount, 160, 700. If you can fall beneath those thresholds, the rest of the complicated mechanics of Section 199A don't apply to you. You simply get, for that line 9, the 20% deduction. But most of you on the call, let's take married couples, you're going to say, but my financial advisory life insurance underwriting income is $500,000. So I clearly exceed these thresholds. And if you exceed these thresholds, there's an opportunity under the center column, the phase-in rule, to lose part of the 20% deduction, but not the full amount. But as you read, only up to 100,000 in excess of the threshold. So if your business income is $500,000 from your life insurance underwriting, and the threshold is just over 320,000, you're going to blow through the phase-in amount. The phase-in amount having maxed out just over $420,000. Consequentially, you're going to have to either focus on planning your adjusted gross income to fall beneath that threshold amount, or looking at the left-hand side of the slide, you're going to have to go into the mechanics of 199A. So the mechanics of 199A are, you have the option of the 199A 20% deduction is calculated on your business income, but then it is reduced to the greater of 50% of the W-2 wages that your business has paid. So if you're an underwriter and you have a secretary who works for you as a W-2 employee, not as a 1099, that won't count, as a W-2 employee, and their wages are $50,000 on their W-2, then at the end of the year, you would have had a 20% deduction against $500,000, $100,000. However, because the W-2 wages are only $50,000 and you're limited to 50% of those wages, $25,000, the maximum deduction you can take is $25,000. Or you have the choice of 25% of those wages. So you're paying your secretary $50,000, 25% is $12,500 of wages, plus 2.5% of the unadjusted basis of all your business operations property. But what business operations property do you have? A computer? Your cell phone? Oh, you've deducted that out as a 179. Your computer, you deducted that out as a 179. You didn't depreciate it over time. Your chances are you really don't have a lot of qualified property. Now, if you're a restaurant owner or your client's a restaurant owner, they're going to have some qualified property. But again, you're going to have to start to work into the mechanics of calculating, using this formula, what the maximum 20% deduction is. If you're that financial advisor I just mentioned, better to bring my AGI down to the threshold amount. Now, let's look at the right-hand column of the slide, service businesses. The 199A, for people who exceed the threshold, does not apply to certain service businesses. Attorneys, doctors, financial professionals, but not your life insurance underwriters, management consultants, you're accepted from the 20% deduction. So if I'm an attorney, I need to fall beneath that threshold through AGI planning if the 20% deduction is going to be useful for me. Once I exceed the threshold, I don't get to use the mechanics of qualified property or W-2 wages. Service businesses eliminates the possibility for me. Now, for those of you who are listening who are in the oil and gas industry, because we're in Texas, engineers, and in particular petroleum engineers, several 100,000 petroleum engineers employed by the industry, employed on the rigs and so forth, you're not included as a service business. So petroleum engineers who are together in partnerships or individually who have their business income, even if you exceed the threshold, you can still take advantage of the 20% deduction. However, because you exceeded the threshold, you have to follow these formula mechanics of the W-2 wage and qualified property. So again, still better for you to play with your AGI. Now let's just talk about some of the anti-avoidance. So by example, clever attorneys are going to say, well, can I divide up my law firm business and segregate part of it into a service business that would qualify for the 20%? Now, I know that my law income can't qualify, but I have other businesses that are part of my law business. Can I segregate that out? I'm a doctor. Can I segregate out my physician services from, by example, maybe MRI services or whatever? So I divide out the business. I have rental income. Can I divide out part of that? Now, the answer is no. The IRS released regulations that require specifically for people who try to split off. So you'll see that term in the left side of the slide, split off their service-related business to qualify for the deduction. It brings that back in and it eliminates that possibility. Also, in the center of the slide, there's aggregation, both opportunities to aggregate W-2 income across your different business lines, but also requires aggregation of that accepted service business income that doesn't qualify for the 20%. So that would the regulations have to be studied closely by a financial advisor if your opportunities are to try and segregate off aspects of the business, or if your client has 5 or 6 different types of business incomes in different business lines through, let's say, 5 or 6 different LLCs. You have to look at whether aggregation is the best for your client or not. And then, of course, there's a complex netting formula to aggregate if you go down that path. Again, the message here is try to fall beneath the threshold. So, moving on. To fall beneath the threshold and to focus in on reducing our adjusted gross income, our AGI, the optimum way to do that is through retirement planning. So financial advisors are very familiar with especially for your own business, your own financial advisory, life insurance underwriting business, to apply, your self-employed IRAs, your SEP IRAs, traditional 401ks for employees, or for the individual who owns, who operates the restaurants, and they have 5 or 6 restaurants with business income coming in. So they're really looking forward to take advantage of the 20% deduction, but then it gets complicated when we start talking about the basis and the W-2 wages. Can I reduce their AGI through 401k? And so looking at the difference between our SEP IRA, our 401k, and then cash balance plans. So I said cash balance plans is where financial advisors really going to get your ears, your eyebrows are going to raise, your ears are going to peak up. And this is where the real opportunity is. So let's start with the traditional, I'm self-employed, so I have an IRA. My contributions are limited to $56,000 a year. So if we go back to my financial advisor, life underwriter, who's selling life insurance and who has $500,000 of business income, and they're married, I can just get to the phase-in amount. So what's that mean? I take my $320,000, I'm just rounding the number. I take my $100,000 of phase-in amount, and that's going to get me to $420,000. So I can contribute up to $56,000 into my SEP IRA this year. That's $470,000. But I made $500,000, so I still exceed the threshold. Is there anything else I can do? And now we have our traditional 401k for the for employees and the employer portion to be paid in. Again, $56,000 limitation. So let's move into our cash balance plans. What's the difference there? Well, our cash balance plan allows us up to actually it's higher than $250,000 because it's based on your age. So depending on the client's age, it can go as high as $260-something thousand. That is a game changer. That takes my $500,000 financial advisor and brings me well beneath the threshold amount, using plain vanilla retirement planning. However, obviously, there has to be a catch or everybody would be doing it. So what's the catch? Well, cash balance plans have a lot of requirements attaching to them that aren't typical of your IRAs and your 401ks. So specifically, cash balance plans aren't actually defined contribution plans that we think about with IRAs or 401ks. They are defined benefit plans. And defined benefit plans require every year an actuarial statement that the assets in the plan are enough to fund the benefit for the retirement portion. That doesn't have to be a very expensive exercise because, and that was the good news for our financial advisor, the good news, you can use life insurance and other insurance products to guarantee the funding of the retirement required amount for the cash balance plan. And in that sense, the financial advisor, life insurance underwriter, you just scored a double win. You yourself, this works for. And you now get to sell your traditional, plain vanilla life insurance where you make your bang for the buck with your clients in a way that's going to bring your clients beneath the threshold that brings them into the 20% deduction for 199A that they can't have but for your life insurance sale. So under traditional estate planning, with the new Tax Cuts and Job Act amount of an exemption of $11.2 million a person, you've had a hard time explaining to clients that don't have really high, ultra high net wealth clients in the $50, $70 million asset range. When you're talking the $10 million asset range, they're not going to suffer any estate tax in the future. And so you've had some challenges with life insurance as a tax vehicle. Now, there are plenty of other good reasons for life insurance, from asset protection to just life planning for spouses and so forth. However, because of the 20% deduction, at least until the year 2026, Congress has written you a new lease on life for your life insurance planning in the context of retirement planning that benefits all business owners. So with that like Christmas gift from Congress under the Tax Cuts and Job Act, I'm going to turn it over to my colleague, Robert Bloink, who's going to go into some other planning elements for 199A and that I think you're going to find interesting. So Robert, I'll do the slides for you, and why don't you start talking about non-grantor trusts?
Sure. Thank you, William, and welcome everyone. Okay, I think we can't talk about 199A without talking about the seemingly endless multiple trust, non-grantor trust strategies that came into play in the marketplace almost immediately as 199A was enacted. Secondly, we need to now discuss the new IRS regulations and how those impact these multiple non-grantor trust planning strategies. But before we get there, let's just talk about the commonalities of all these strategies. So from William's discussion, the key planning point when we talk about Section 199A is avoiding that income threshold amount. So fundamental to all of the non-grantor trust planning strategies that bandied about the marketplace in the last year or two was to avoid that income threshold amount by fractionalizing ownership of the entity. So if we had one owner who would otherwise be subject to the income threshold limitations of 199A, the simplified theory of all of these non-grantor trust strategies was to fractionalize the ownership such that we had multiple owners, and each of those owners would apply the 199A income threshold limitations separately. So in its simplest form, if we had one owner, we then assigned ownership to that same entity to two non-grantor trusts, and the theory would be that we've effectively doubled the income threshold limitation under which we can obtain a 199A deduction. And by this logic, we can not only double it, but multiply up the income threshold limitation by as many non-grantor trust owners as we create for that entity. So by fractionalizing ownership, we're going to increase the income threshold limitation by a factor of 2, 4, 5, as many as needed, was the base theory of all these non-grantor trust strategies. And thereby avoid any of the complicated mechanics that William was talking about earlier of the phase-out provisions of the 199A provisions. So there's multiple variations of this strategy, but they all rely on that commonality. We're going to multiply through fractionalizing ownership the income threshold limitation that applies to 199A. Now, William, if we can jump to the next slide, we'll talk to how the new IRS regulations limit this type of planning. Specifically, the new regs introduced a three-prong test. Essentially, if we've got the same grantor or grantors of the non-grantor trust, substantially the same beneficiaries of the non-grantor trust, of which we fractionalize the ownership, And then thirdly, if the principal purpose of creating the trust was tax avoidance, the aggregation rules are going to apply and therefore eliminate the benefit of the non-grantor trust strategies, because the regulations are going to aggregate all those owners into one and apply one income threshold limitation as to all those aggregated owners. So immediately I get the question when we talk about the new regulation is, well, what about the third prong? Couldn't we set forth a fact pattern in which the principal purpose is not tax avoidance? So it's important to note to start with is that on this third prong, the presumption of the regulation is that tax avoidance is the principal purpose. If you bifurcate, if you've fractionalized ownership amongst non-grantor trusts, it's presumed tax avoidance was the purpose. It's rebuttable by the tax. So how can we rebut that? Certainly there are business reasons to fractionalize the ownership, whether it be centralizing the asset management, aggregating of ownership of an entity among a family group, in the context of estate planning, avoiding repetitive asset transfers in that typical succession planning, or simple asset protection. You're just trying to protect the equity interest in the entity from creditors. Or it can be akin to a spendthrift trust, where you're trying to relieve a given family member of the obligations of managing their portion of the ongoing family business, but still allow them an equity interest, a management tool, if you will. All of those could be reasons to rebut that presumption that tax avoidance is the purpose. But on that note, I have to make the point that no credible planners, when they're discussing the 199A deduction, are going to rest their hat on rebutting that presumption. The fact that you would be fighting an uphill battle is not the starting point we want to go with. So with that said, there are multiple non-grantor trust strategies that will work to multiply the limitation, the income limitation that would otherwise limit the amount of the 199A deduction, but they need to be part and parcel of a greater, whether it be estate planning or simple succession planning strategy. And that ties into the first two prongs of the test, that we have the same grantors or grantor, and then substantially the same beneficiaries of all the non-grantor trusts. In every instance, we're likely going to have the same grantor or grantors transferring ownership of the entity to the non-grantor trust. But if we now have distinct beneficiaries for each of the non-grantor trusts, then the principles of a multiple non-grantor trust strategy would work. But that entails your business owner giving up beneficial interest in some portion of the business, which is going to be a pushback for a considerable number of clients. But it would work in the context of succession planning or estate planning, where the closely held entrepreneur is trying to transfer some portion of that entity to the next generation, the grandchildren, as the case may be. If we can set up a scenario where each of those non-grantor trusts have a unique beneficiary, think a sibling as a distinct beneficiary for each of the non-grantor trusts, then we're in a situation whereby the new 1099A regs aren't going to stop the benefit of the multiple non-grantor trust strategy. But it's only in the context of that succession planning where your client is comfortable with unique, distinct beneficiaries of each of the non-grantor trusts that this is going to work. So in the context of succession planning, estate planning, the multiple non-grantor trust strategy can work and effectively eliminate the problems with the income threshold limitations of 199A and expand by a factor of as many number of non-grantor trust owners as you have the amount of 1099A deduction available. But only it's in the context of those unique beneficiaries and part and parcel of succession or estate planning. So with that, I'm going to turn it back to William and let him summarize some of the key takeaways of our discussion today at 199A before we open it up for questions. William? William, you're going to need to unmute your mic. There we go.
Am I muted? I'm muted.
No, you're good. You're good, William.
Okay, right. Okay, so the key takeaways today, we like to give 3 or 4 takeaways for every lecture we do in our program. The Section 199A deduction is designed to give that tax break for our pass-throughs that is similar to the reduced rate given to C corporations, to bring a 21% rate C corporation to try and bring our earned income as an individual after distribution of dividends from a C corporation, bring them into alignment with a 10% difference right now, as I mentioned. Number 2, calculating the 199A deduction is extremely complicated once you exceed the annual threshold limitation. So number 3, you want to focus on minimization of that AGI techniques. It's more important than ever. And you get to number 4, kill 2 birds with 1 stone by minimizing the AGI through retirement planning. So the life insurance underwriters who are the typical student in our wealth management program, again, this has been a huge Christmas gift that was given to you on December 22nd of 2017 with the enactment of the Tax Cuts and Job Act. With that, we are interested, for those who think that this topic is fascinating and would, for us in our class, we spend a week going, very deeply into the topic of 199A, not just an hour. And so if you're interested in this and you thought these kind of strategies are interesting to learn about, then I encourage you to find out more information about our wealth management program that is open for both lawyers and non-lawyers. So for your typical financial advisors, wealth managers, compliance officers who are looking at the risk management side of the business, and directors of financial planning, and so on. There's a link on this slide, and we encourage you to, again, to discover what we're doing here at Texas A&M. It's completely online with plenty of opportunities to participate in on-campus seminars and so forth. So with that, there was a questions feature for the webinar, and are there any questions from the attendees? Libby, are you moderating?
Okay, William, we've got them on the right here.
Okay, I can't see them because I'm doing.
Okay, I can read them out loud. Sorry, I was talking on mute. So we have a first question from Scott. So Scott says, I found it interesting that some clients have QBI when they are not active business operators. For example, their K1 has passive income categorized as beneficiary share of Section 199A. So the passive investor gets their share of the QBI on their 1040 without ever having to actually run a business. The question is, I guess the policy goal was to encourage passive investment in a small business.
Well, so the answer is, let me guess, are they invested in a REIT or a PTP, a publicly traded partnership in the oil and gas industry of Texas? So, I mean, this is kind of, Machiavellian, tax policy lecture, but was the QBI written for the small business owner, or was it actually written for the oil and gas industry of Texas? Because the greatest beneficiaries of the 20% deduction apparently are the investors into publicly traded partnerships PTPs, which includes, of course, the master limited partnerships, the MLPs of our midstream oil and gas industry. So, Scott, you are correct that your client's there. But then again, in you have that Christmas gift because they're probably also going to exceed the threshold as it stands right now and looking for solutions for their, to bring them down. And again, that cash balance plan may be really appropriate for them. It may be, as Robert talked about, the grantor trust strategy with different beneficiaries and so forth. Okay, Robert, you have anything to add? I think that's it.
No, I think you've covered it well.
Yeah. Next question.
Perfect. Yep. The next question is, when does a business owner need to fund contributions, employees, employers, same or different due dates, to a SEP IRA, 401k, etc.? Is that December 31st or April 15th of next fiscal year, or even extension if filed?
Same tax year. So what the question really is, oh my God, I'm listening to the webinar today in 2019. What about my 2018 QBI? Can I reduce my AGI backwards? Well, if the plan's not already set up, so yes, there are some catch-ups. If you already have the plan in place, there are some catch-ups that last until the first, through the first quarter of the following tax year. But what you can't do is now set up the plan for 2018. Also, each plan, we don't have time to cover it today. We cover it in our retirement and benefits course. But when you go through each plan, the SEP, IRA, the 401k, the other machinations of 401ks, the cash balance, each of them have different regulatory schemes. So, how many employees, what percentage of my employees do I have to cover? Do I have to have equal amounts going in, or can it be discriminatory amounts, and so on? So by example, with a cash balance plan, you don't have to cover all your employees, but you have to cover a substantial amount. So what's that mean? Is it 40%? So 40% is at least the general rule. You have to cover at least 40%. Is it 60%, 70%? And that's where the financial advisors value added, in the advisory capacity. You're not just a life insurance underwriter salesman. You're actually advising the client on their retirement and benefit planning that, of course, obviously saves for their retirement days, but on how to enhance their employees' experience, which enhances their business itself through the retirement system, but in an affordable way. So they may not be able or want to cover 100% of their employees. What is the maximum threshold for that, and so on. So the answer is yes, there are catch-ups written into the retirement systems. However, those catch-ups do require the retirement systems, the regime that you've chosen to go with is already in place for 2018. It can't be an afterthought this year for last year. But the good news is you're in 2019, there is a QBI deduction for this year, and it's not too late for 2019 to set that up and start funding it. Robert, you want to add anything?
No, is there more questions, Libby?
Yep, we have a couple more. So the next question is, where would a 162 executive bonus plan see fit in addition to the qualified plan and cash balance plan?
So with the retirement planning, again, so let's say it's a 457, which I'm more familiar with, deferred comp. As long as the pre-tax dollars going in are reducing the AGI, you're in the 199A category, reducing that threshold. You're in good stead. But if you fall outside of that pool, then you're not reducing your AGI for 199A. And so, of course, still there's lots of other comp plans out there, but they don't necessarily work as pre-tax dollar comp plans. And thus, for purposes of 199A, they're not the most appropriate vehicle. It doesn't mean they're not appropriate for other situations, and you'd want to keep them, but just not for this particular deduction, which, of course, again, will sunset in 2026, absent Congress doing something.
Thanks. Okay, this next question is about the LL.M program. How many hours a week would have to be dedicated to be successful in the degree program? I'm an in-house counsel for a large agency with a very demanding caseload.
Okay, so the good news is all of our students have a minimum of 5 years experience in industry, but our average years of experience is over, I don't know the exact figure, but it's over 11 years. It's underneath 15 years. It's like 12.8 years. They're all like yourself. They all have demanding jobs. They're all higher level management in their in their companies that are paying for the program. I say not all because obviously we have a lot of underwriters also, but the 15 hours a week per course. Now the good news is we do one course at a time. So our courses are 7-week courses. Our semesters are 2 courses over the semester, but they're back to back. So you do one course for your 7 weeks and then do the final project exam paper has to be submitted. That's in your week 8. And then you start your next course. And so the semester is 2 courses, but it's divided one course at a time. So for the one course at a time approach, you need to spend 15 hours a week, but you need to spend it focused on one course area. So if for some programs, you're doing 2, maybe even 3 courses at once, and I understand that. However, for the really busy professional, because we polled industry, it's not like I built something and it's like they will come. We went and hired a very expensive consultancy to go out and ask industry what would be best for industry, and industry told us the program has a really useful fit for lots of lack of skill sets or lack of knowledge areas for what they need to better do their jobs. However, what they did not want is to have fragmented learning where they would be having to be trying to read 2 or 3 different books, areas of information, and do their jobs at work, which are all multitasked. So nobody has the one little job area at work. They're multitask on different functions, many different clients. So they didn't want the program to overburden an overburdened workforce already. So we've structured it, I think, very well with the one course at a time, each course 7 weeks, spend 15 hours a week. You could spend as little as 10 hours, but generally I say 15 hours to get the maximum benefit from the program. That includes your class time on the webinars, on the interaction with your faculty, your study time, and interacting with the other students in your team-based learning experiences.
And William, I can note right now in my tax class, I've got a general counsel of the family office, very similar position, and they seem to be doing well with the asynchronous nature of the program. Not only the one course at a time, but the asynchronous, that you're able to pull the materials not necessarily on the planned schedule of a typical residential setting. And that combination of one course at a time, plus that it being asynchronous where you can pull it on demand when you're available, seems to make it work for our executive students.
Yeah. And all the students get to come together and meet each other at different networking events we have on campus, both at the law school and on main campus at College Station. So every October, we host the, College Station hosts for us, but we piggyback our big financial planning conference. And literally hundreds of people come who are Aggies, of course, in the programs. And it's not open to outsiders, but hundreds of people come, the big institutions, and we spend 2 days learning, sharing, networking, team-based group projects, and so forth. And then, because it's always a Thursday, Friday, and then on Saturday, we go see a football game. Is there another?
Great, thank you. We probably have time for one more question. If anybody has any questions to submit, just a reminder, the webinar was recorded and you'll get it via email, or we invite you to visit the Texas A&M Law School website to learn more about the wealth management master's programs. Will there be more webinars in the future?
Yes. So, I mean, in the context, so our classes, our live classes aren't exactly like this because they're interactive with the students. So they're, with the videos showing the students talking to each other and with the professor. However, we're used to doing this video or webinar based videos every single week in our program with our students. And thus it's what we're thinking about the future to expose the program to more people in the financial industry, both who sit on the front office, that's you, the wealth planners, or in the back office, that's the compliance and risk officers, is to bring some of the cool strategies that we explore, during an entire week of class, to spend an hour exploring them on a webinar to expose you to some of what we do. And then, if you find it interesting, please, talk to our admissions people about whether the program meets, what you do at work, meets your requirements, reimbursement wise, will it add value to your career, and so on. So I really thank everybody who came to our webinar today. Time is valuable and everybody's multitasking. We recognize that. So, and if you're watching the video later on, feel free to reach out to Robert or I. Robert's a real practitioner. I say Robert's a real lawyer. I'm an academic full-time 100%. So while we're both authors of, I'll show you the Tax Facts series, and we encourage you to use our books. We write, over 4,000 pages of content that sell 20 to 30,000 print copies a year, I think, to the financial planning industry of underwriters and so forth. So we have a lot of answers to questions. It's literally written in a Q&A approach. So we have a lot of answers to questions that you can ask, that we can find in that. But advisory work, well, that's your job. You are the financial advisor that clients are coming to. So, so our objective is to empower you to be able to analyze these issues on your own in the future, to research and find the information on your own in the future, that you start, maximizing your client billables or your assets under management in the future. That's our objective. So you can reach out to us in that context. But in terms of, employing myself, I'm a full-time professor. I can't do that. Robert, on the other hand, real lawyer. Feel free to reach out at any time. So
thanks for that plug, William. Is there more questions, or do we need to wrap this up, Libby?
That's all the questions we have. So good timing. I know we're at the top of the hour. So
don't want to,
thank you again for everyone that joined us. Thank you to Professor Byrnes and Bloink for sharing their expertise and their insights. You'll get an email shortly that will include the link and also more information on the online wealth management master's programs. So we hope you have a great rest of the day, and thank you for joining us.
Thank you, everybody.
Thank you, everyone.